the engineer here. This will be a video for an introduction of another layout that I use for my trading. This layout is called Trinity. And this specific layout, I monitor the trading average. I know that many of you doesn't consider Dow Jones at all, only ES and Nasdaq, but I like not to look for an SMTs, but I like to measure the strength of the index markets compared with another one like Nasdaq with ES and Dow Jones. Okay, so before I talk about this specific layout, this is a very unique way that I use this specific tool, the Dynamic RTH Gap Pro. Okay. We were taught that to look for an SMT or a cracking correlation, we should look for failure swings to measure the strength of one asset in comparison with another one. Okay, so imagine that you have this one and the other one took this, and you consider this as an offset accumulation here, and this one was just a normal accumulation or repricing this an imbalance or here, I don't know. So this is an SMT, a normal SMT. You are measuring highs and lows to compare the strength of the asset. Well, I don't use that at all. What I do is I measure how the asset is behaving to his own regulatory hours gap and the projection of the gap. Okay, so in this layout I have a white background because it's I don't use it like for a long term in my monitors like all the time. It's just for a quick view. Okay, so I have Mondays regulatory hours gap only here, extended through the week, and it's yellow. So in this way I can see the gap that was formed during the first day of the week, that it's Monday, and the projection of the gap. It's like these deviations. And the other one that I have here is all the other days, Tuesday, Wednesday, Thursday, and Friday here, and it's green. So when the gap is fully rebalanced, it will be green, and the projections are gray. So for me, it's really easy to follow how the gaps and the structure and how price is behaving on this for the standard deviation. So okay, so a quick introduction. Imagine that this is a regulatory hours gap. Okay, okay, so you have two you have two. This will be for Nasdaq, and this one for ES. Okay, so when the market opens, I always measure the strength in time-based windows. Okay, so imagine this is a macro. 950. This is gold, completely gold for your trading. If you are diligent and you do the work and study this, you will find gold. So this is 950, and this is 950 on ES. So imagine that you're bullish, you're expecting higher prices, and Nasdaq opens, this is a 930 opening, moves lower, reach the upper portion, and at the macro, price begins to move higher and leaves the gap. Okay, but another way on ES we have this scenario. We reach in the macro the consequent encroachment of the gap, and price reach only, I don't know, imagine here above the market we have one standard deviation here, like this, and Nasdaq reach 2 deviations of the gap. Okay, so this is a complete framework for my trading. And so imagine that you are looking for an SMT here and you don't see an SMT at all. Nothing. It's the same structure on both of the index, but we are trading in a different quadrants of the gap in the same time windows. For me, this is a cracking correlation between both of the index for me. So this is the way that I measure the strength of one index. So only for this reason, I already know the Nasdaq is going to be the best for longs, and it will provide me the best the best long. And while ES, it will be bullish also, but maybe we can reach lower targets like 1 deviation, and with Nasdaq we reach 2 standard deviations. So this is another way to measure to see for a cracking correlation in price comparison, the strength that the market has in measuring with the gap, within the gap, the quadrants, the consequent encroachment, and so on. Okay, so let's see some examples and you will see why it's so important for me. Okay, today, for example, I took a long here. Here we took this here we have electronic trading hours sell side here, and this is a breaker. Take this short and low. This week is a sensitive point. We tap here and we reach to take the buy side here, and we reach, look the standard deviations here, look perfectly, we reach 2 standard deviations here to the tick. Then we move higher and we reach what? Again, 2 standard deviation of the gap, and we reverse and we reach 4. This is really powerful for me. I use it every day. So when I am anticipating like a protraction, or a manipulation against the side of the market that I want. For example, if I'm looking for higher prices, ideally I would like to see a manipulation of that move and reach like 2.5, even 3 or 4 standard deviations, and you can anticipate and use these levels as the same way, but as targets, like here. Okay, so look. Yesterday, here we have ES. We were trading at the 10 open here, the 950, 1010. This is a macro here. We were trading at the upper quadrant here to the tick of the gap, while ES was trading at the consequent encroachment of the gap, just below and move higher. So because ES reached this level of this gap, is telling me that it's not that strong like Nasdaq is. Okay, so look at what the market did. Nasdaq was moving higher and cleaner. And look, for example, yes, this protraction here, this retracement was really deep, because it was not strong like Nasdaq was. Do you see? So you can measure and compare the strength of the asset, measuring how the price is behaving in macros inside of the key levels of the gap. This is huge. Upper portion, consequent encroachment, lower quadrant, and finally the closing price, the settlement price here, the close. And the same for the projections. Okay, imagine that you are reaching, I don't know, here for example today we reached 2 deviations, while ES was reaching 3.5, and we were trading at 2 standard deviations here from yesterday gap here. So for me, this area was a really point of interest to see if we can reverse or take partials for a long, and look what the price did here. We were trading at this projection. So you begin to stack confluence of previous projection of the gaps with the actual price action of today and the same projections. So you can refine this, and you are looking for a reversal around 2.5 and 3, or around this area here, and price reverse. And for this day we were trading for Nasdaq, we were trading from Tuesday gap at 4 deviations here, 4 deviations. From yesterday gap we were trading at 1.5 projection, and from Monday's gap we were trading at 2 and 2.5 here. So for me, we were really in premium from the weekly opening. Okay, obviously I didn't take any short, but I took the long, and was good. So how can you make this easier for you? Well, I have here my alerts, my logs. I have the alarms on here. Gap fills, quarters, and consequent encroachment alerts. So it's really easy. The way you toggle this on is you can click here, add an alert here, and any alert on function call, here the tool, and create the alarm. So every time that price reach, could be the consequent encroachment, the quadrants, or the gap fill, you are going to receive an alarm here. And you can by, I don't know how to say it, but automatically you are going to assume that, for example, if Nasdaq reach the upper quadrant of the gap while ES was, you have the notification that, or the alarm that reached the consequent encroachment, and you are in a macro, you already know that Nasdaq is failing to move lower, and it will deliver a better long or a clean long, and you can trust that as a short. So look, for example, and I will move like on this day. Where's price here? Okay. Yes, what's this? No, was not this date. I don't know what day was the day that we had that breakaway gap. Let me see. But you can compare almost every day, and you will see, like for example, this day. This was another good example. Yes, here. Okay, like this. Nasdaq fully closed the gap here, while ES was trading above the consequent encroachment. We failed to reach the 50%, and ES was delivering a better long. You see, the movement was cleaner and without like chopping around like here. This is another day, but on this day was really clean and was longer. It was a better move on ES than on Nasdaq, because the reason that I told you, Nasdaq was fully repricing the gap while ES was failing to do that. So for me, this is I can measure that ES is gonna be better for longs, and you can anticipate SMTs, like for example here. Look how Nasdaq was doing like deep retracements. This is like 15-minute chart, but look on ES. It was a really, we failed to take this low here on ES while Nasdaq did. So you can anticipate SMTs because you already know that ES is gonna be the one that's going to make the high. So you are one step ahead of the SMT without measuring like highs and lows, and so you are measuring how price is behaving in relation to the gap. This is very unique. This is something that I do, and I will share with you this same layout in case you want to use it. And I use it white because it's really, I don't stay very long, so it's very sharp. I can put a lot of attention in the quadrants of the gaps and the deviations. It's very clean. So this is why it's white, the background and the colors like this. Okay, so this is a book. If I receive a lot of message about this. This is not the regular trading hours gap on this day. If you change your chart to electronic trading hours, this is actually the real gap. But we are doing like we are fixing this bug in the script. It's because the bank holiday. Okay. So I already know. I know that if you see this video and you are using this layout and doing back testing of this concept, you're gonna send me a message that, oh, this gap is not this. Yes, I already know. So it's I'm telling you. Okay, so this is everything for this video. Study this approach and how you can use it in your trading. You can combine this with SMTs, or it's fine, but I like to follow price like this, and if I'm for example intraday trading. But yes, so this is everything for this. Hope you find this insightful, and have a nice day, guys.